Well, it's 3 o'clock. Let's go ahead and get started.
Perfect.
So everyone, thank you for joining today's webinar. We know your time and attention are yours and it's valuable. So today our goal is to get you as much value as you can when it comes to both the cost segregation and your accelerated depreciation, as well as what we're seeing in the property tax space for California. I'm here today. I've got David with CCSI, and we have a presentation to share with you. I'm going to start the presentation, and David, you take it over and go from there.
Yeah, Wes. So if we have we have a handful of people here, so don't be afraid to jump on the chat, ask questions. Let's see. I don't know where my chat feature went, but ask questions, and we'll be happy to answer those along the way. So Wes, if you want to move us up to the first slide, I'm not here to make you a depreciation expert. It's I give webinars to CPAs, tax professionals. It's not uncommon to have 400 people on some of my calls. So I can really put you to sleep really quick with the tax code. Mechanical engineer talking about the tax code. That's not my purpose today. What I want to do is make you aware of some of the deductions that are available to you if you own a new building, if you're planning on buying one in 2022 or recently bought one, or have an older building like this ugly one in the second picture there that may be able to have cost segregation done on it. So it doesn't matter if you've owned the building for several years. Wes and I might be able to help you save on your taxes. So that's what I want to try and do, is bring to your attention opportunities that you might have, like repairs, renovations, things that you're doing now. The tax code is extremely generous for doing interior renovations and repairs. So I just want to make you aware of a few of those things and tell you how to do that. And the process is called cost segregation. You have two choices with the IRS. You can depreciate the building as a whole and depreciate that over 39 years or 27 and a half years for apartment complexes, or you can look at the parts and pieces of that building and identify those that the IRS lets you accelerate depreciation on. You can get those deductions sooner rather than later. Wes, if you want to go up one slide, I'll explain that. The Big Mac analogy. If I were to explain or to describe a Big Mac with straight line depreciation, I would say it's a hamburger. I look at it as a whole. But if I were to use cost segregation terminology to describe that Big Mac, it's there. Those people above 40 know the jingle. 2 all beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun. Nobody goes into McDonald's and orders a Big Mac like that. But that's what you want to do on your depreciation schedule. You want to list all the parts and pieces, or the buckets that these parts and pieces fit in, because some of those buckets, some of those parts and pieces, you can accelerate depreciation on. Wes, if you want to advance the slides for us one more time. So here's my bucket analogy. A cost segregation specialist is going to go into your building, look at all the parts and pieces and kind of segregate them into different buckets. We've got the 39-year bucket, 27.5-year bucket. So if you're doing straight line depreciation, everything's in the top bucket. Everything's the same category of depreciable years that it takes to fully depreciate that asset. A cost segregation specialist is going to go in and say, look, there's some 5-year property that we can accelerate depreciation on that goes into a different bucket. Hey, look at all these land improvements outside, parking, striping, landscaping, flagpoles. All that goes into a 15-year bucket, qualified improvement property. All the items that I can identify, segregate, and put a value to, you'll be able to depreciate those in the first year of ownership. So anything that I identify will have a 15-year depreciable life or less. The IRS says anything with a 20-year depreciable life gets bonus depreciation. Wes, if we could go to the next slide, please. So here's kind of a list of the things that fit into those buckets. Let me take the second column there. 5-year property. Decorative stuff, wallpaper, moldings, carpeting, flooring, cabinets. all of these are items that we would identify, give a value to, document, and then put them in a report where your tax professional would say, I can write all that off in the first year because it's 5-year property. We can look at land improvements, the last column there. We've got parking lot stripes, again, flagpoles, fencing, so forth. All of that can be depreciated in the first year if it's segregated and identified separately or in these buckets. If you're doing renovations or remodels to a commercial building, anything on the interior, sheetrocking, painting, flooring, anything that you're spending on the inside of that, you can write that off in the first year if you know how to do that, if you have a cost segregation specialist come and help you with that. So let me show you what that causes. Wes, if we could advance the slide again. So here's some graphs just to show you the value of what a cost segregation study can do for you as far as accelerating depreciation. The blue line here is a straight line depreciation model that looks at the building as a whole. That's the hamburger, right? So if you don't want to segregate all the parts and pieces of your building, you're going to get the same deductions every year for the next 39 years or 27 and a half years if it's an apartment complex. If you apply cost segregation, will be the orange line or the red line there. In the first 5 years, you're going to get a spike in these deductions. So you're going to get about 20% of your building is going to depreciate in the first 5 years. If you apply bonus depreciation to that, which 2022 is the last year that you'll get 100% bonus depreciation, all the items that are identified in a cost segregation study as being 5-year or 15-year property, you can take in the first year if you can utilize them all. So you see the green line, you get these huge amounts of deductions. So say you have a $2 million building, a new building, you purchase that. You have a cost segregation specialist go in and identify all the parts and pieces that qualify for accelerated depreciation. You might get 20% of that building, maybe $400,000 of that $2 million building, you can write off in the first year. That 400,000 times your tax rate, more than likely, if you're above a 30% tax rate, you're above $120,000 of cash flow in the first year if you can utilize this. So it's a cost segregation specialist that's going to be able to identify and predict, here's the deductions that you're eligible for when you're getting that. So Wes, if you would go along one slide, please. Okay, so the things to be conscious of: cost segregation, identify the parts and pieces so that you can utilize potentially 100% bonus depreciation on those parts and pieces, eligible for properties September 27th, 2017 and beyond. If you had a building and you bought a building in 2018, 2019, or 2020, back then, the regulations were a little bit different. There was a glitch in the language, and those parts and pieces were not eligible for, interior parts and pieces were not eligible for bonus depreciation. So if you bought a building in 2018 or 2019, you want to go back and do a cost segregation study on that building, because 2018 and 2019, you couldn't accelerate depreciation on qualified improvement property, interior renovations, remodels, but now you can. So again, if you're doing an interior renovation or remodel of your building, you buy the building, you've had it for a couple of years, you're going to change out some leasehold property, whatever that is, you're eligible to write almost 100% of that off in this year. So whatever you're spending, that's almost 100% deduction for you. Something like LED lighting. If you're changing your LED lighting, you're going to remove the fixture, throw that into the dumpster. That's called partial asset disposition, where you're throwing something away that has a value on your depreciation schedule. You're able to write that off. So LED job, LED retrofit, fixture that you remove, how much remaining depreciation is in that fixture? We calculate that, goes in the dumpster, there's a write-off. The LED lighting that you're putting back into the interior of the building, that's 100% write-off as well. So, if you're going to spend $100,000 on an LED project, you're going to be able to write off $100,000 and get $100,000 of deductions. That's $37,000 of cash flow. if you have someone do all the documentation. So anything that you're pulling out of your building, if you're going to do a large renovation, remodel, retrofit, have a cost segregation specialist come and look at that, document everything before you start ripping it out, because it's a lot easier and you get more value if you're able to say, okay, here's how many walls I took out. Here's how much electrical and plumbing. A cost segregation specialist is going to hand you a report that says, here's what you threw away. What you're putting inside, cost segregation specialist is going to say you can write off almost 100% of this as qualified improvement property. If it's a commercial building, residential, it's not, you're not eligible for it, but commercial, you are. Residential remodels, what you throw in the dumpster, you're eligible for. What you put back in, we can go and identify the parts and pieces that might qualify to write those off. So this is what a cost segregation specialist, everyone needs a depreciation specialist on their speed dial. So if you don't have one, Wes and his team would like to, and my team as well with cost segregation services, we want to earn a position on your team. We want to be that depreciation specialist that you can call and say, hey, here's what I got. Tell me what it's worth. So if there's any questions, or Wes, if you have any things to chime in on, please do. Oh, it's and let me thank you, Wes. I was about to miss this slide. So passive versus active income. So if you're a passive investor, if you've bought the property and you're leasing the property out, or if you own a portion of that property, you're a passive investor. Therefore, it's passive income, and a cost segregation study is going to be limited to be able to wipe out all of your income, but not create a loss. If you're an active investor, if this is a trade or business that owns the building, if you're a real estate professional, this will be active income and you're not limited. We can create a loss. Therefore, you can apply those losses to your other active income, maybe your salary, whatever it might be. So if you're a passive, again, you're limited to just wipe out all of the income that you're receiving. But if you have multiple properties and you're getting passive income from other buildings, you're able to put these deductions against that income as well. So if you have lots of properties, you can do a building or two, apply that to all of your income, and take that down as you see fit. So these are just some of the strategies that we would ask you to consider. You know, friends don't let friends overpay their taxes. This is why the real estate moguls pay so little taxes, because they have depreciation specialists that are getting them every deduction possible. That's why we've teamed up with Wes and his group to be able to try and make sure that friends don't let friends overpay their taxes. We want to make sure we're getting you every nickel you deserve. So there you go. That's my pitch. That's good enough. So Wes, let me hand that over to you. Zipporah, it's I'd be happy to share this presentation and a longer presentation with you as well that goes into more detail if you would like. Just reach out to Wes and his team and we'll be able to get that for you. Wes, tell me about Paramount.
Thank you. So we get often asked, like, why should we appeal our property taxes? And the question or the response I always give people, well, would you let the IRS do your taxes? So why are you letting the assessor do yours? And when I say that, then, you know, people really go, yeah, now I get it. Basically, I wanted to share what some of the latest things are going on as far as property tax goes for issues with COVID and or what we're seeing post-COVID. So as we all know, home prices have gone up. So our appeals of high-end homes has definitely been impacted. However, we do foresee when interest rates change that some of the higher end markets like Rancho Santa Fe, Beverly Hills, Palm Springs area will start to go back down to somewhat normal numbers. Industrial, we haven't seen any decreases in industrial right now. What we are seeing in some markets is office is when companies are deciding that, hey, they're scaling down. They don't need as big of a floor plate or as big as a footprint. We're starting to see vacancies in some markets increase. That's going to be something to watch in the near future. And retail, even though there is consumer spending's up, one of the things that we're hearing from all of our retailers is, hey, I have the demand for another space. However, I can barely get enough employees to operate my current space. Why would I consider going into a different space when I can barely get the staff that's needed? So we think the workforce shortage is going to impact retail as well. The next one is hotels. Even though hotels have rebounded, there's still hotels that are along near convention areas, airports, and some other hotels that have not been impacted or that have not recovered. A lot of our hotels have great occupancy and RevPAR through Thursday through Sunday, but their Monday through Thursday is a ghost town. It's completely empty.
Wow.
One of the things that we're doing a lot of is new construction appeals. The assessor typically gets these wrong. Most people, when they build a building or apartment building, they assume, hey, whatever I spend to build, that's what the assessor is going to assess me on for new construction. And what we're seeing in some counties like LA, 30-40% over what they spent on cost. Just last week, I reduced the apartment building in San Diego on new construction from 118 million down to 94 million. And change of ownership. So when Prop 19 came in effect, there was a lot of people that were doing some change in ownerships, and they were doing it either correctly or incorrectly. But what we saw is the assessors are automatically triggering reassessable events, and we're having to go in and fight those and get them reversed. So if you buy a new property, why should you look at appealing or at least talk to a property tax consultant for a new acquisition? So often investors purchase a property based on the income, on the in-place income, rather than what the current market rents are. In most cases, the county assessor never reviews the rent rolls. They just see that, hey, this is what you paid for it, and it looks to be aligned in market. They don't really care or look at what the in-place rents are at the time of purchase. Also, if you bought a property such as, let's say, a hotel or a gas station or assisted living, those are three property types that we're doing a lot of, I would say, acquisition appeals, where we go in and say, for example, someone buys a hotel for $10 million. Well, of that 10 million, $500,000 is furniture, fixtures, and equipment. And then another 300,000 could be value for such as the trade name, workforce in place, liquor license, etc. So what we're doing in these cases is going in, appealing it, saying, hey, here's the true real property value. And here's what the value is of the goodwill, intangibles, furniture, fixtures, and those need to be removed from the real estate valuation. So the moral of the story is, if you buy something, reach out to us and we can look at seeing if you have a case. What we have a lot of large clients do is reach out to us even before they buy the property for us to start looking at consulting with them. And what we can do is help out fill out preliminary change in ownership reports. I did that for a golf course last week. They were closing and I helped them fill out the paperwork. So it goes into the recording. So they're putting on the record to the assessor that this property came with business goodwill value, and that value should not be assessed. So why should you review your property taxes? So property taxes on average represent 30% of actual operating expenses. What we're seeing potential for what we call a decline in values are properties that were purchased in the year frame of 2005 and 2008. And even though property values have increased since then, the rate of the property tax assessment is going up 2% every year compounded. So there's a good likely chance that your assessed value, we can get it lowered just because of the compound factor. And what we're seeing also is people who bought in, say, 2016, 17 through the start of COVID. And then also tenants and then also these properties that the tenants are responsible for paying the property taxes. So as a tenant, if you're responsible for paying property taxes, you can actually file an appeal as well, not just the property owner. Property owners whom the original assessed value was greater than the purchase price or cost of construction. So oftentimes the assessor will not enroll the purchase price. We go in and fight those. Cost of construction, even if the assessor enrolls your cost of construction, I would still have us take a look at it. We think we can, so in some cases, get it below what it costs to build. About a year ago, I won a large case. Client built a very large home for over 50 some million. I was able to prove that the market value was only 30 some million. So he was happy about that. Type of assessment appeal. So you have real property, which is land and building. We also do business personal property. So this is equipment, fixtures, furniture. We represent a lot of biotechs, food processing plants. We're even doing a mine this next week. Possessionary interest. So this is property like if you're in San Diego, it would be the Port of San Diego. Long Beach would be Long Beach Port. The Santa Monica Pier is on a government ground lease. We do a lot of those. So if you have a possessionary interest, definitely give us a call. We see a lot of opportunities and reductions on those. Prop 8 reduction, that's your 1 year change in value. And those were real popular back in years 2011, 2012. As well with COVID for years 20 and 21. And then a supplemental or a base year appeal is where we appeal either a new construction event or a change in ownership. And the same thing with the base year. And then they have the calamity. So our office is involved right now with filing calamities for properties that were impacted by COVID. And we feel pretty strongly that on the possessionary interest properties, we're going to prevail. So how does the refund work? So property taxes appealed is always recommended when there's data support a lower value and assessed value. The filing period are typically between July 1st and November 30th. A few counties in the Bay Area have September 15th deadline. And the date of value for this year would be what is the value as of January 1st, 2022. This is some information on comparables. Typically for commercial properties, we're doing income approaches. And then valuations. So we've at the value as of 1/1/2022. We can look at market comps. Those are usually going to be for more of industrial buildings. And then we have most of the retail and everything else. We use an income approach. Cost approach, we really only use that for assisted livings, hotels, and gas stations, and some new property and some complex property. So the application process is pretty simple. Basically, you would send us an authorization. We file the appeal. Then about 8 to 10 months later, it gets scheduled. We then start to negotiate with the assessor. If we can't come up with a settlement, then we go what's called a formal appeal hearing where it's scheduled. And myself or my staff goes and we present our case of why we're right and why the property should be reduced. And then we also argue why the assessor's wrong. Typically right now we're doing about an 80% win rate, a success rate. And due to COVID, a lot of the appeals have been virtual like this webinar. This time I'm opening it up to anyone who has any questions. Here's our phone numbers. If you'd like to reach David, he's at the 225 number. And then Wes Nichols here. This is our San Diego office. You can reach me here as well. Does anyone have any questions?
Wes, I have a question. What valuation of building makes sense? It's what's too small to do?
Too small to do. We try to keep things at least over $1 million. If it's a unique situation, sometimes we'll take on smaller stuff if it's potentially has an interesting legal situation.
Okay. And for cost segregation, I mean, we can make it work down the buildings that are $300,000 and above. I know in California, $300,000 building is not much, but we can make it cost effective and make it cash flow in that situation. So,
and I'm glad you brought up about the passive versus non-passive because I didn't know that. So, are you saying if you're a real estate agent that if you have an investment property, you can write that off as a loss even? or is it only the building that you're occupying for your business?
So if you're, we do a lot of work with real estate brokers. So if you're listed as with the IRS as a real estate professional, and there's a long list of, have 750 hours in the business, and lots of things, but you have your own properties that you're participating substantially in, leasing those, renting those, they're eligible to have that as active income, so we can create losses that go beyond the rent that they're being paid for that. So then they can start wiping out some of their income, W-2 income. So that's so for real estate professionals, this really works well. We do a lot of work for brokers that own lots of commercial real estate.
So it sounds like to me, this would be something that if you're not already, you might want to just go get your real estate license so you can have that classification.
It would be helpful. But you've still got to materially participate in your building. So if you're just a passive investor, if you're just one of the investors and you're not actively in charge of managing that property, that wouldn't really help you. But anyway, but we can help people understand how they qualify, or if they qualify.
Got it.
Yeah.
Well,
so
if anyone has any questions, you can call or email David and ours. I just checked. It looks like we answered all the questions. So if anyone has any questions, they can raise their hand, and you can ask David or I your question. Renee, what's your question?
There you are.
Renee, can you hear us? Renee, do you have a question?
Wes, I have a question for you. How do you get paid?
Most people choose a contingency-based service.
Mm-hmm.
We prefer that because, one, we believe on if we don't win, then you don't owe us anything.
Okay.
Some of our larger clients, they do hourly because the reductions can be very large.
Mm-hmm. Okay. And you said taking things to phase 3, you're looking at about an 80% success rate.
That's what we're looking at.
That's pretty good. I want to meet your guy that paid $50 million for the house, but it was only worth 37. Is he a Russian oligarch?
No. he built a fabulous property. So yeah, it was an interesting appeal, and we've done everything from 1 million square foot food processing plants to minor league baseball stadiums to poultry farms. Right now, I think next week we have a quarry mine that we're doing. So it's interesting, some of the things that we get involved in and get to learn. And one of the things I love about this business is I try to learn as much as I can from my clients, mm-hmm. because at the end of the day, the clients, that have owned these properties for a while are very well knowledge based on, how their property performs, some of the challenges, their industry and whatnot. So we try to learn as much as we can from them and use that into our arguments. And then one that we're really looking forward to is we did a hospital this year. Hospital was purchased for $36 million right before COVID, and the assessor in LA County gave him a tax bill for an assessment of $113 million. You can imagine that was pretty shocking, especially right in the middle of COVID when they're trying to buy masks and gowns for their staff and they get stuck with such a large tax bill.
Sure.
We appealed it. We're waiting for the decision, but we think we're probably going to get it down from 113 down to $42 million.
Wow.
Which will help this hospital out because it really services the, poor and underserved in LA County community. So it's definitely going to be something interesting.
Wes, do you have off the top of your head a dollar amount for going from that high down to the 42? What's that mean for savings for them, roughly?
Millions a year,
Wow.
millions. Yeah. Definitely
Nice.
help out their operating costs.
Oh, absolutely.
Let's see here. It looks like Ms. Kelly or Keller Zipporah, do you have a question?
Yes,
Appreciate
please. I would like to have both of you the copy of the webinar.
Yes, that's not a problem. We can it's being recorded and we can email it out to everyone here that's attended.
Plus the recording, right? Recording of the verbal.
Yes.
Yes, that's correct.
Thank you.
You're welcome.
You're
Looks like,
welcome.
do we have any more questions here? Nope, that's it. Well, folks, you know, I appreciate your time and attention. I know many of you are busy running and operating large properties, so I appreciate your time to look into this and invite you to come. Everyone here will get an email link to the recording, and if you have any questions, our phone numbers are in there as well. Thank you so much for your time.
Thank you.
Thanks. Been a pleasure. We hope to help.